Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's talk about one of the issues that's bound to come up next week. Two key data points ahead of the Fed's September decision, kicking off with payrolls tomorrow and CPI next Wednesday. Housing costs remaining a top concern for many, including the former Secretary of Housing and Urban Development, Shaun Donovan. Shaun is the current president and CEO of Enterprise Community Partners and joins us now. Shaun, good morning to you.
John, great to be with you.
Thank you very much for coming on the programme. Let's just talk about the scale of the affordability crisis that you've been talking about for a while and we've been living through. Are we finally coming out on the other side of this?
I don't think so. And in fact, it's getting worse in places. I've been doing this work a long time, about 30 years. And I think what is different is really two big things. First, it is a problem that is deeper than it's ever been. We have the biggest rent increases we've ever seen. We have a doubling in what it costs to buy a home in the country in the last few years. But the problem is also everywhere now. It used to be on the coasts. It used to be in our bigger cities. I was in Boise, Idaho last week, and they have a housing crisis there. And so it really is everywhere. It's also driving our economic challenges in a way that I've never seen nationally. Our inflation problem is a housing problem now. You have companies who can't attract workers, and it's driving down economic growth. Half of all our renters in the country are paying more than 30% of their income, which is unaffordable. That's $8,000 a year they could be putting toward groceries, consumer demand. And so it really is at a different scale, and it's in our presidential campaign right now. 33 governors across the country talked about housing affordability in their State of the State address. So it really is a different crisis than I've ever seen. And it is moderating from COVID, but at a level that is unlike anything we've ever seen.
I'll ask a dumb question and you can give me a complex answer. Are we 200 basis points away from solving this crisis with a few rate cuts?
Absolutely not, because we are 7 million housing units short of what we need. This is a supply problem, not just a rates problem. And that means we've got to take action in many, many different ways, both on demand and on supply.
When you listen to the campaign trails, both of these individuals sound populist in nature when they talk about the housing market. Kamala Harris saying first-time buyers can get $25,000, a benefit to help them. Don't you think that would exacerbate the problem we are seeing right now?
Well, let's be clear. Harris's plan does both. It focuses on supply. It looks at over-regulation. It looks at the need to encourage states and locals, even require them to build more. But we also have to recognize that for a family, that the real struggles are for families who can't even put food on the table. We have a record homelessness crisis. And so we do need to figure out how to help people afford housing more. We're never going to bring that cost of housing down enough that most people can afford a decent place to live, right? So, and that's really, you have to have a balanced program.
It also doesn't matter what Trump or Harris say, because this will be done in Congress. How could you see potentially a divided Congress get to any resolution on something like housing?
Well, this is what's so interesting about the way the politics have changed on housing. I said earlier, 33 different governors. I've been in Boise, Idaho, in Montana the last few months. Red states, blue states. Give you another example. We had a tax bill that made it through the House of Representatives overwhelmingly, the most bipartisan thing I've seen. There was a significant increase in the low-income housing tax credit, the best public-private investment vehicle we have to build more affordable housing in the country. And so I think this really is a moment different from what we've seen in the past, where there is bipartisan support around housing. And I think in the tax negotiations next year, you're going to see a big increase in the low-income housing tax credit.
As those policy discussions continue, and presumably will take some time, going back to John's point, if the Federal Reserve cuts by 200 basis points in the next 12 months, will that make the home affordability crisis worse or better?
It will definitely help. It will make, obviously rates are a critical thing, not just for home buyers, but for builders out there. And so that will be important. But I want to go back to the fundamental problem. For many, many years, we've been lagging on building housing, and the supply problem has got to be focused on if we're really going to get to the solution.
You talked about how this is a problem that's widespread, and you talked about U.S. cities, but it's widespread globally. And actually, cities across the world are dealing with this affordability crisis, and a lot of people are saying it's because of how low rates got, and because a lot of people could leverage up their home purchases, and thus lead to higher prices. Why won't lower rates just do that again? We've already seen home builders building as fast as they have in a very long time during the pandemic, during high rate times. So what's to say that they're going to keep up?
Because we have to recognize that housing is a financial instrument, but you can't build it if you don't allow zoning to build that. So in a neighborhood where a community is saying, not in my backyard, I don't want any more housing, there are different measures of it. Harris's plan says she would add 3 million units. Our numbers are for real affordability. We have 7 million units shortage. So rates are just a piece of the issue, but fundamentally what we allow to be built and how we, for the lowest income people, how we support them to do that is critically important.
You're an expert in this with a lot of experience, a lot more than anyone around this table, that's for sure. Harris is offering two things, wants to incentivize building, but also support buying. And I think we all understand there is a mismatch in the time horizon for those two policies to bear fruit. You can support buying, that works immediately. The supply issue is going to take years to play out. In the near term, don't you risk higher prices with these kind of policies?
You have some risk, but understand, for a family that is right now spending half of their income towards rent or to own something, that increased support might mean they put more food on the table. It might mean that they do other things to support their family. So it has some effect, and there is some risk to what you're talking about. But at the end of the day, we know we have to do both. We have to support supply and demand. And I do think what's exciting right now is you have a consensus around the country for Democrats and Republicans that we have to build more. Here in New York, we have a City of Yes proposal. In Montana, they just passed legislation that says cities can't restrict housing development in certain ways. So that is a growing momentum. And you're right, it will take time. So we better get started.
How long has this problem been building for? Maybe we can finish here and just give you a big picture opportunity. You were part of the government coming out of the financial crisis, the housing crisis, 08, 09. Were the problems now, were the seeds planted back then? The lack of supply? How connected are these two issues?
So what I would say is this has been a chronic problem over decades. Housing affordability has been getting worse for probably 50 years in this country. But it's really become an acute crisis through COVID. COVID gave it a jolt of adrenaline in terms of making the problem worse. I want to go back even before the Obama administration, given that we're on Bloomberg TV. I was Mike Bloomberg's housing commissioner here in New York City. Yep. And this was a huge focus for us, is taking old industrial areas, rezoning them. Right now, we have 1 billion square feet of empty office space around the country. That's an opportunity to really think about. So absolutely, this is a problem that's been building, but it is different now in terms of what we saw during COVID. People are demanding, those people who used to work in an office, they're now working at home, they're demanding more space at home. And so we have a demand that's grown enormously during COVID that we have to meet.
This was super smart, and we look forward to doing it again with you. Thank you, sir. Pleasure being here. Appreciate it. Shaun Donovan there of Enterprise Community. El-Hillow of Russell Investments saying the inflation problem is largely solved at this stage. Expect we'll hit the 2% inflation target in early 25. The Fed has the space to be aggressive if needed on rates. We still expect a soft landing, but we can't rule out the possibility of a recession. Kate joins us around the table. Kate, good morning to you.
Great to be here.
Thanks for joining us. Let's start with payrolls tomorrow morning and the data through the next hour or so. Yeah. What are you and the team looking for?
Well, we're looking for a beat on what we saw certainly in July and something close to like the 145, 165 range. And if we get something close to that, we think the market is pretty positive. Continue to see some of this broadening out. Any chance that we are below 120, below 100, that's where you start to see some material volatility.
So good news is good news, and bad news is definitely
it's really bad news.
Bad news. Talk to me about where that would leave the bond market tomorrow morning.
Yeah, so I think, again, I don't think the bond market's moving tremendously unless you see the labor market really start to show more signals of a weakening versus a normalization, and then potentially start the recession discussion to be more prominent. We're not there yet, but if you start to see some challenging prints in terms of labor, that's where you start to see some movement.
This is really interesting to me. You think it's an asymmetric response, that essentially
Yes.
people are not going to unwind what we've seen in terms of the rally in the bond market. Yeah. What gives you that conviction?
Yeah, well, I'd say a couple things. First, I think the first 100 basis points of cuts, whether it happens this year or it kind of drips into next year, is kind of easy to get to. The 200 or so that's being priced in through the end of next year, that's where you might see some movement still, but you still end up having like terminal rate. You still have a while to go to get there. So again, I think if you get some good news, the labor market's more normalizing. July was maybe a little bit of a misshoot, but the Fed is still moving to focus on the labor market and not inflation. That you don't end up seeing a big shift back up in rates, because we know that the direction is pretty clear.
We were talking about the incredible volatility of markets at a time where there are so many unknowns, and there just is this feeling that one data point could really tip the scales in a pretty significant way.
Yeah.
Do you basically view bad news as being a buying opportunity? I mean, if you end up seeing a negative, some really problematic print, can you say, look, you look at the fundamentals, you look at these companies that are performing pretty well, all right, time to buy?
Yeah, I mean, I'd say a couple of things. It's great to actually see volatility back in the market and the market reacting. I think the challenge is it's overreacting to single points or news. And so we're staying pretty close to home in terms of our strategic allocation. So if we see those overreactions, we are leaning into them. It tends to be more as trimming our winners, i.e. even when rates have moved up or moved down over the past period, we've been trimming. If we see a big sell-off, we'll be leaning in. But I think it's more because the overreaction that we're seeing from the markets because of the volatility and the uncertainty. The market's still trying to find kind of the narrative.
When you say trimming in the bond space, and then we'll go to the stock space, are you basically saying that the market has priced in too many rate cuts?
Yeah, so we think that the magnitude right now is at the point where it's probably as much as it's going to go unless we start to see a recession theme start to pick up. So we have started to trim some of our duration positioning.
Connor Sen, Bloomberg opinion.
Yeah.
Love Connor Sen.
He's great.
Check out this tweet. If the Fed was unburdened by what has been, get it? Fantastic. And if the Fed had a blank sheet of paper to begin with, they'd probably set Fed funds around 4% instead of where we are right now. Instead of this performative chatter from various people about the signal it'd send if they cut by 25 or 50 and the anchoring to 525 to 550, can we play that game? Just some scenario analysis. If we were to have a blank sheet of paper at the Federal Reserve, what would the rate be today?
425, 450?
Yeah. So we're about 100 basis points offside of the Fed.
Yes. Yeah, which is why I'd say the first 100 basis points is easy to get to, so you don't see as much movement. It's the stuff further out that we're still trying to figure out in the magnitude of how far they go.
We've heard that number a few times, haven't we? That maybe they're 100 basis points offside. So to Connor's point, what is this performative chatter about? The signalling from 25 versus 50. If you're offside, get a move on and just say you're offside.
Isn't the Fed, and this isn't meant as a pejorative, but isn't the Fed essentially a performative instrument? Isn't it sort of the signal that they give to markets?
They behave that way, yeah.
Well, and so at a certain point, and that really goes to this question of how do you trim positioning? How do you understand whether they're on a trajectory that's much steeper, akin to what Al-Hussainy was talking about, where they could go back to zero, versus between 3 and 4%?
Yeah, and I think that's where you don't make any kind of severe moves because there is a lot of uncertainty, and try to take advantage of the volatility.
Kate, this was awesome. Busy 24 hours ahead for you and the team. Thanks for dropping by.
Thank you.
Thank you. Kate El-Hillow there of Russell Investments. Ed Al-Hussainy of Columbia Threadneedle writing, the Fed put his back. One of the key unknowns is how the economy will respond to the Fed executing rate cuts. If the pass-through of cuts into the real economy is slow, the Fed may find itself behind the curve once again. Ed is with us around the table for more. Ed, good morning and welcome back.
Hey, fantastic.
You said in your recent note that market pricing marks a broad distribution of outcomes. How wide are the range of outcomes right now?
Yeah, I mean, it's striking. If you look ahead, we're starting to price well in excess of 100 basis points this year. And if you look into the end of next year, the probability that Fed funds manages to stay at around 4% is close to zero. So it's a fantastically broad distribution at the moment and getting broader every week.
And there's a feeling it wouldn't take much weak economic data to really amplify some of those bets. That if we drop to 100K tomorrow morning and unemployment stays at 4.3%, we start pricing in a series of 50 basis point cuts. So if you're facing these kind of outcomes and the range is like this wide and you can drive a truck through it, do you chase this bond market rally? What do you do with this?
Well, I think we've had a really strong rally so far this year. I think what we want to do is take stock that the starting level of yields is still quite attractive, that the curve is likely to continue to steepen versus what markets expect. And so that gives us a little bit of juice. At the same time, I don't think you want to be maxed out. I think you want to leave a little bit of dry powder for an environment in which the data manages to surprise us to the upside.
I was struck by the fact that you hear the likes of Howard Marks saying that the neutral rate in this new environment is something like 3 to 4%. But if you look at this wide spectrum of potential outcomes, you actually see an average rate below 3% by 2026. Do you think that that's maybe overestimating the chance the Fed really does get down to close to zero again?
Well, I think there's a really strong probability that that happens in the coming years, right? That the data deteriorates to the point where unemployment starts to feed on itself. You get those recessionary dynamics. In that environment, the odds that the Fed funds rate goes to zero, I think, is exceptionally high. And Fed research does continue to point to that probability being high in the coming decades. Will it happen in the course of the next 12 to 24 months is anybody's bet. We have a significant amount of fiscal uncertainty on the flip side of this election, that may forestall a recession. But if the dynamics are there, Fed funds going back to zero, I think, is a very reasonable assumption.
There's a pretty profound sort of extrapolation that I'm feeling from you, which is that essentially this is not a different environment than pre-pandemic. That essentially this is not a more inflationary time than we were in 2019 and 2018. And this flies in the face of what a lot of investors are saying, including some pretty big ones. Can you explain why you think so?
Yeah, look, I think the large part of the inflation story, and again, this goes back all the way to the mid-90s, is driven by anchored inflation expectations. We've run this massive experiment in the course of the past 3 years, the extent to which those inflation expectations form a center of gravity that pulls inflation towards 2%. And I think it's played out really well. It's underscored the Fed's credibility in maintaining that level. I don't see any reason why inflation should be different going forward unless the Fed's strategy changes. Inflation, at the end of the day, is a financial variable determined by the Fed.
If the Fed cuts by 50 basis points, then 50 basis points again at a time where the economy is not falling off a cliff, isn't that the variable that could cause a higher inflationary environment?
We're going to find out, right? If, in fact, that neutral rate is closer to 4%, that means the economy is going to be very sensitive to rate cuts straight out of the gate, right? 100 basis points of cuts could significantly accelerate growth, could put upside pressure on inflation, and then we're not going to get, Fed funds below 3.5% in the coming 24 months. This is a key unknown. We just don't know at this stage, given how much flux we've had in the course of the past 2 to 3 years.
I'm pleased that Ed has said all this because you have to realize how finely balanced things are going into tomorrow morning. We're one bad jobs print away from pricing in a series of 50 basis point cuts and one good one away from reversing a lot of what we've priced in over the last few weeks.
And essentially, what we don't know is what the responsive markets will do to the underlying economy. We keep talking about how this isn't a very interest rate sensitive economy, as many people expected, on the way up. What's to say it will be on the way down?
Should I fear the disinversion? Can we finish there? When the curve starts to normalize and you get this bull steepener, typically that means bad things are about to or are happening in the US economy. The rate cycle is just about to start or is happening. What is it this time? Could it be different this time?
Not as much. I look at the curve and I see in the course of the past, again, 12 to 24 months, the curve was deeply inverted, signaling that the Fed has taken us to a very restrictive place. They're taking the foot off that brake pedal right now, and the curve is disinverting. The pass-through into the real economy, I think, is an open question, right? You had your previous guest talk about the sensitivity of the housing market, the housing capex, to those interest rate cuts. It's a key unknown to this day. If, in fact, we see that housing demand come back, housing capex come back, on the flip side of the election, potentially corporate capex reaccelerate, the Fed's going to have a really high floor in terms of other cuts relative to what's priced today.
Ed Smart, as always, thank you, sir. Ed Al-Hussainy there of Columbia Threadneedle. Jobless claims came in at 227. The median estimate was 230. I said earlier, if you walked into a room of economists, you'd walk back out confused. If you look at this data this morning, you're not getting clear direction either. Jay Bryson of Wells Fargo is challenged with solving some of these issues. Jay, what is going on in the labour market in America?
Well, John, I mean, I think you kind of talked about it before. I mean, you know, what we're seeing is we're just not getting as much hiring as we had before, and I think that's consistent with the ADP number we got this morning. But we're also not seeing businesses laying people off, and that's consistent with the initial jobless claims number. So, you know, the labor market has moved back into better balance, which is a good thing. Things are slowing down out there in the labor market, but, you know, and I think Lisa used this word earlier, you know, you're kind of on a knife edge right now, and, you know, you don't want things to deteriorate further from here.
Jay, what gives you confidence it won't? Is there any reason to be confident that things stabilise? That this isn't just a moment in time, it's an end state for the rest of this year?
So I think there's two things, John, that things kind of stabilize here. And, you know, recession is not the base case call. One would be, if you look at the financial position of households, in general, it's pretty good. Yes, we have seen delinquencies go up on credit cards and on autos. We've seen, you know, we're hearing anecdotes of low-income consumers feeling some stress. But if you step back and you look at the debt situation, if you look at the debt service ratio of the business of consumers, it all remains pretty good. And the same thing applies to the business sector in general. Businesses in writ large don't really have to lay people off, you know, in aggregate right now. And so those, I think, are two good things to take a deep breath. Things aren't falling apart out there, and, you know, a continued expansion is probably still the base case.
Jay, let's say the base rate right now is 100 basis points lower, and companies had an easier time borrowing at a more reasonable price. I guess, would you start to see a pickup in hiring based on the fact that companies are still hopeful, and frankly, the reason why they haven't been more aggressively hiring is in part because of uncertainty around the economy as well as the election?
You know, Lisa, I think that's part of it, but, you know, we're also seeing, when you look at the overall economy, you are seeing signs of softness, right? We all know that, you know, the housing market has been kind of soft for a while. We all know that manufacturing is also soft right now. The only real thing that's really holding up the economy right now is the service sector. And so, you know, when we get the ISM number at 10 o'clock, that will be important to tell us what's going on in there. And so, you know, as rates come down, you know, the point here is that should help to stimulate sort of things. I think there's some uncertainty, whether it's towards the election, whether it's towards the economic outlook in general. But, you know, in general, what we are seeing is monetary policy is in a restrictive stance right now. Rates do need to come down to help stimulate spending.
Jay, is this normal to have this level of uncertainty? The knife's edge that John was talking about, this idea that things could tip the scales one way or another. Is this always how it feels at tipping points that seem to last forever with such model data?
Yeah, you know, so there's always uncertainty out there, right? And if you go back, you look at the pandemic, right? That was a very fast-moving sort of situation. You look at the financial crisis, lots of uncertainty around there. Absent a major shock, and, you know, the last major shock was the pandemic a few years ago and the unwinding from that. Absent a major shock, I'm kind of hard-pressed to think of a time in the last, you know, few business cycles when things have felt a little bit uncertain as they do right now. So I do think it's not normal right now, given where we are. But we're, you know, unfortunately, just the nature of the way the economy works and the way the overall geopolitical situation works, there's always a base level of uncertainty.
You said earlier, not much hiring, not much firing. Sounds very Goldilocks. But we heard from Mike McKee was just talking about hours worked will be important. What kind of number of hours worked would you need to see to then get concerned that potentially the next point of call is going to be layoffs?
Yeah, so if we're seeing, aggregate hours worked tomorrow going down, let's call it 0.3% or something like that, then I'm starting to get a little bit concerned, at that point. And so I think Mike had a really good point there in terms of the hours worked. And, the first things that you do see is you see temporary workers start to go down. It's like 24 out of the last 26 months, we've seen the number of temporary workers going down. So we're already seeing that. And if we do start to see hours worked going down by that magnitude, 0.3%, 0.4%, then I'm really starting to get a little bit concerned.
Jay, thanks for the update, sir. Jay Bryson there of Wells Fargo.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.